One of the best performing companies in my portfolio ended up being one of the biggest investment disappointments for me. At one point, it looked like it could be the standout winner in my entire portfolio. The valuation was climbing, the momentum was strong. On paper, everything looked right, and then it failed. That experience completely changed how I think about angel investing, because venture is not just about finding exciting companies and watching valuations go up. What matters is what happens underneath the surface. Timing, structure, follow-on capital, founder decisions, market shifts, and how fragile momentum really is. I want to talk honestly about what I got right, what I missed, and the lessons I think every angel investor should understand from it. Hi, I'm Rupa Poppet, the founder and managing partner of Araya Ventures and House of Araya. Now, when I first came across this company, I was immediately excited, and I already had a very strong view that this particular market was going to evolve in a certain direction. And here was a startup that not only saw the same shift, they had actually already built the product and launched it within about 3 months. There was a solo founder who was also an experienced second-time founder, and the execution speed was exceptional. As part of my due diligence, I downloaded the app and I started beta testing it myself. I found a few things I thought could be improved, so I emailed the founder feedback on a Friday. By the following week, all of it had been incorporated into the product. What I was seeing was in real time was speed of execution, founder obsession with the problem and the solution being built, and an incredibly tight feedback loop. Those are often some of the biggest signals in early stage investing, and therefore I invested at the seed round at a £25 million valuation. After that, the growth of the company just accelerated. At one point, the company grew over 1,000% in revenue. The founder was raising both more equity and debt financing, and the business was scaling so quickly. Soon after our investment, we heard another funding round was taking place, and that was at a 10 times markup from my original investment at £250 million valuation, with some institutional venture capital funds coming on board. It wasn't long after that we heard the company had received a term sheet that would value the business at over $1 billion. Just for context, when a company receives a term sheet, it means that the VC fund has already done a significant amount of work and wants to move forward with the deal. The high-level terms are agreed, due diligence is well underway, and so this felt really real. Some of us angels who had invested together started discussing secondary sales with the founder, because at that valuation, it could have represented over a 40 times return for me from my initial investment. And personally, it meant a lot to me emotionally too, as of my first major exit. So I'd had exits before, but this would have been by far the biggest. It would have returned more than double the total amount I had invested across my entire angel portfolio. Essentially, one company could have paid back the entire portfolio twice over and made every other investment effectively free from that point on. At that point, it felt like everything was working, the thesis was right, and this was going to be my breakout company in my angel portfolio. But then the market changed, and this is something I think newer investors massively underestimate. Just like stock markets, venture goes through cycles, and suddenly the environment became much harder. The $1 billion term sheet was pulled, the market reset very aggressively, and the valuation that had existed on paper no longer existed in reality. The founder worked incredibly hard to secure alternative funding, but runway was tightening, burn became more stressful, and the company had also taken on venture debt. Unfortunately, debt changes things, and once debt enters the picture, time pressure increases dramatically. You no longer just need growth, you need liquidity as well. And then one day, not so long later, we were informed that the company was having to shut down. It was really difficult because this wasn't a bad founder. This wasn't even a product that didn't work, that customers didn't want. In many ways, it was one of the fastest success stories I'd backed. But venture can be unforgiving, and sometimes companies can grow incredibly fast and still not survive the combination of market timing, capital structure, and funding environments when it shifts. In hindsight, I think a mistake was that there should have been the stronger investor representation on the board. The VC funds that had invested didn't take the board seats, and governance is about creating accountability, oversight, and support as companies scale, especially during hyper-growth journeys like this. When companies are growing quickly, things can look amazing externally, while the operational stress is building internally. Without strong governance structures, those warning signs can get missed until it's too late. So on paper, I had 40 times return on my investment. But until liquidity actually happens through a secondary sale like the one we were exploring, through an acquisition, or through an IPO, it's not real. Venture is just not linear, and it's important to note that venture can reverse extremely quickly, especially in changing macro environments. A lot of newer angel investors struggle with this emotionally. You start mentally counting outcomes that haven't happened yet, but the number on paper is not money in your account. Sometimes investors want every success or failure story to feel fully controllable, but timing matters enormously. The same company in a different market cycle may have survived. The same term sheet 6 months earlier may have gone through and been completed. That doesn't mean the founder suddenly became worse. It means venture is deeply tied to liquidity environments and timing. Debt can absolutely accelerate growth when used correctly, but it also reduces flexibility in times like this. So when equity markets tighten, debt can become extremely dangerous for startups that are still scaling at pace. Startups are already fragile businesses, and adding debt increases the consequences of timing risk considerably. You can identify, I believe, a great founder, a real market shift, strong execution, and genuine growth, and still lose money. Venture investing is about portfolio construction, so when those asymmetric outcomes come, and those opportunities exist, you've got enough in your portfolio to have the chance of having multiples of those. This experience completely removed the illusion that success is purely about spotting the exciting companies early. A lot more has to go right after that for it to be a success. As an angel investor in this deal, I walked away with several lessons, including that it matters which VC funds you invest alongside as an angel, as they can play a governance role as the company scales. I also learned about the dynamic between debt and equity in a round. It hasn't put me off investing, especially not angel investing. It just further informed me of the potential upside these startups can have, and it took me back to the fundamentals that matter most: diversification and portfolio construction. As ultimately, the failure of this company actually had little downside impact in my overall portfolio returns, given the strength of all of the other companies in the portfolio, but it had the potential for that huge upside had it gone well. I still genuinely believe that many of the original insights behind this company were correct, but as you see, venture investing can be humbling, and sometimes your biggest lesson comes from the company you're most convinced about that then doesn't work out. I'm going to be sharing more of these stories from my actual portfolio over the coming weeks. Real deals, what I was thinking at the time, what actually happened, and what I would do differently. Because this video is about what breaks a thesis, and I want to give you something that shows the other side. I've put together a free teardown of one of our actual investments at Araya, what I saw, how I evaluated it, what the terms looked like, what happened, and what I learned. It's called Inside the Decision. It's a PDF, it is anonymized, and it is completely free. You just need to drop your email to access it.